Welcome to NexGen Finance, your guide to making smart money moves without the fluff. Today, we're diving into the top 5 money mistakes to avoid in your 20s. Let's get started. First up, living beyond your means. It's tempting to splurge when you start earning your own money. But remember, just because you can afford the payment doesn't mean you can afford the purchase. Avoid getting caught in the debt cycle by budgeting wisely and tracking your spending. Many young adults fall into the trap of using credit cards to fund a lifestyle they can't truly afford. This can lead to accumulating high-interest debt that's difficult to pay off. Instead, create a budget that prioritizes essential expenses and savings goals. Use tools like expense tracking apps to monitor where your money is going. Consider adopting the 50-30-20 rule: 50 of your income for needs, 30% for wants, and 20% for savings and debt repayment. By living within your means, you'll build a solid financial foundation and avoid the stress of debt. Next, not saving for emergencies. Life is unpredictable, and an emergency fund can be a lifesaver. Aim to save at least 3-6 months of living expenses. This cushion can prevent financial stress and keep you afloat during tough times. Start by setting small, achievable savings goals. Even saving $20 a week can add up over time. Keep your emergency fund in a high-yield savings account where it's easily accessible, but separate from your everyday spending. Avoid using this fund for non-emergencies. Think of it as your financial safety net for unexpected situations like medical expenses, car repairs, or job loss. Building an emergency fund takes time and discipline, but it's one of the most important steps you can take to secure your financial future. Third on the list, ignoring retirement savings. It might seem far off, but the earlier you start, the more you benefit from compound interest. Even if it's a small amount, contribute regularly to your retirement fund. Your future self will thank you. Take advantage of employer-sponsored retirement plans, like a 401k, especially if your employer offers matching contributions. If you're self-employed, consider opening an individual retirement account (IRA) or a Roth IRA. Set up automatic contributions to make saving easier. Remember, the power of compound interest means your money grows faster over time, so the earlier you start, the better. Don't let the complexity of retirement accounts intimidate you. Educate yourself and seek advice if needed. Starting early can make a huge difference in your retirement savings. Fourth, overspending on non-essentials. Those daily lattes, dining out, and impulsive shopping sprees add up. It's okay to treat yourself occasionally, but try to be mindful of your spending. Small sacrifices now can lead to big savings later. Create a spending plan that aligns with your financial goals. Identify areas where you can cut back, like dining out or subscription services you don't use. Use budgeting apps to help you stay on track. Consider implementing a cooling-off period for non-essential purchases. Wait 24 hours before buying to see if you still want it. Redirect the money you save towards your financial goals, like paying off debt or building your emergency fund. By being mindful of your spending habits, you'll find it easier to manage your finances and avoid unnecessary debt. Finally, avoiding financial education. Many young adults overlook the importance of understanding personal finance. Invest time in learning about budgeting, investing, and managing credit. Knowledge is power, and it can significantly impact your financial well-being. Start by reading books, taking online courses, and following trusted financial blogs and podcasts. Join communities and forums where you can ask questions and learn from others' experiences. Consider working with a financial advisor if you need personalized guidance. Understanding basic financial concepts like interest rates, asset allocation, and tax strategies can help you make informed decisions and avoid costly mistakes. Make financial education a lifelong commitment. It will pay off in the long run. To recap, avoid living beyond your means. Save for emergencies. Start your retirement fund early. Watch your non-essential spending, and educate yourself on personal finance. Thanks for watching. If you found this video helpful, give it a thumbs up and subscribe for more NexGen Finance tips. See you next time.